Hey, this is Geoff Gannon, and you're listening to the Focus Compounding Podcast. This is the podcast where Andrew and I talk general investing concepts. If you want to know more about specific stocks I like, go to focuscompounding.com, where you can read stock ideas written up by me and other members. Membership costs $60 a month, but if you use the promo code podcast, it'll be $50 a month for you. Andrew and I also manage accounts for investors. To learn more about our managed accounts, email Andrew at info@focuscompounding.com. or text or call Andrew at 469-207-5844. That's 469-207-5844. And now here's Andrew with your regularly scheduled podcast.
Welcome, welcome, welcome. How's everybody doing? Hope you are doing well. My name is Andrew Kuhn, sitting alongside Geoff Gannon today here with the Focus Compounding Podcast, ready to go over some business and talk about some fun stuff that we love to talk about, which is stocks and investing. Geoff, how's it going over there?
Very well. How's it going with you?
It is going great. Going great. Thank you, everybody, for joining in. If you do want to get access to Geoff's weekly memo that he sends out, or you want to become a member, sign up using the podcast promo code if you like to save $10, and they'll take $10 off of the monthly price. Also, if you want to get free stuff from us, become a free member. Go to Focus Compounding, and you'll see a place to do that. And all you have to do is enter in your email. And you become a free member. And there's going to be content on there, and there is content on there, so it's a lot of fun. So from our last week's podcast, we talked a lot about our research process or our research pipeline,
right?
And inadvertently, in talking about that, we're also going over 5 different categories that we like to think through when analyzing a company. And surprisingly, we got a lot of emails and people DMing me, just sort of asking a lot of questions about it. So I figured we could just spend a podcast just talking about that.
Okay.
One thing that we added last week to the list from the prior weeks was is the stock overlooked. So for everybody that isn't familiar with this, every time we look at a company, we have about 5 filters that we like to go through to sort of rank the stock, if you will. And the first one is the stock overlooked? So if it's not overlooked, we're not even going to look at it because our firm focuses on overlooked stocks, which we define as just off the beaten path type of stocks, spin-offs, illiquid stocks, illiquid microcaps, stocks emerging from bankruptcy, nets, companies like that. But so is the stock overlooked? Do I understand the business? Is it safe? Is it good? And is it cheap?
Right.
And obviously, if you don't understand the business, it doesn't matter if it's safe, is it good, or is it cheap? We just kind of go on to the next thing. Too hard pile. So I thought, though, we should just spend some time just sort of chatting about that, and maybe people can add these filters to their own, sort of investor toolkit. And we could use it to talk about Residuo, which is a stock that you are going to also rewrite up for the stock or for the website, which you have written up in the past.
Yeah, if you're listening to this, then it's already up.
Correct. And that
the revisit, I should say. It's already been, I've written about this originally for the website a while ago, but I'm revisiting on these 5 points.
Yeah.
And that article is actually already up for members now.
And the ticker is REZI.
Yes.
Cool. So is the stock overlooked? I kind of just hit on that a little bit.
Right.
But maybe you just kind of want to go over that and how you think about it?
Sure. So is the stock overlooked? So for Residuo specifically, it's a spinoff. So that's why we would have looked into it. And when I first wrote it up, it was a planned spinoff from Honeywell. It hadn't actually happened yet. In this case, I talk about it in the revisit. I would say that there's 3 ways that I can score something: either no, maybe, or yes. And in this case, I would say maybe. It meets our criteria of being overlooked, which is that it's a spinoff. So that's one of the things that we would consider buying for the managed accounts as a spinoff. So it qualifies technically. But I would say compared to a lot of things that we own or might own, it's not particularly overlooked because this is a company with, after the spinoff, a over $2 billion market cap.
Yeah. So it's going to be on a lot of people's
It does analyst
radars.
calls. Yeah, they did an analyst call where there were some analysts on it. They might not be the biggest analysts around, but there were plenty of analysts who will cover it now, things like that. So there are stocks that are very overlooked, which would be ones that are more illiquid, that don't communicate with earnings calls, things like that. Some dark stocks, plenty of more overlooked ones. So this is for a $2 or $3 billion company, it's probably pretty overlooked. And in the first year, you could kind of say any stock might be overlooked if it's a spinoff, because there's obviously a lot of people who own Honeywell who might just sell this stock right away when they get the spinoff. Yeah.
And so it fits in the maybe category because although it is a spinoff, it is, I guess, in that $2 billion range. If it was now, if it was less than $1 billion, like let's say $500 million, it would probably be 100% yes, it's an overlooked stock.
Right. So the 2 things are this is a liquid stock that's pretty big, $2 to $3 billion, and also management sort of has an investor relations department. Basically, they put out a presentation, they do earnings calls, they sort of do some form of guidance, telling people that like their previous guidance was too low, things like that. So those are all things that are very common among very big stocks.
Yeah.
But among a lot of the stocks that we own or might own, they don't do guidance. There's no analyst calls. There's just really no investor relations department at all.
Yeah, and I guess to sort of demonstrate a little bit more, you wrote up an article on Virtu Motors, which is a company that's on the London Stock Exchange, right?
Right, yeah.
And you even said that it's still a maybe, even though the company had a $200 million market cap. Correct. But because it wasn't a spinoff, it didn't necessarily fall in. But I guess it could, because that's a microcap. I mean, how we define it.
It is.
Yeah.
It's basically a microcap because if you adjust for the currency exchange rate, it's about a $200 million stock in the U.S. And it's on AIM.
It's like 150 million pounds. Yeah.
Yeah. So it's on an exchange in the U.K. that is for smaller companies and more overlooked companies would be on that exchange. But it is in the car dealer business, and that's one of the things I would look for overlooked. What tends to happen with overlooked stocks is they're in an industry where you don't have a lot of analysts covering things there.
Sure.
So the issue there is car dealers are very well covered. And you see this a lot with stocks that are overlooked tend to be in industries that are sort of niche industries or something, and much less likely to be in things that everyone covers. Mm-hmm. So... if they're a leader in a really small industry or something, that's much more likely to be overlooked. We talked about Tandy.
Yeah.
That's the kind of thing that just doesn't get coverage or something. Or, but we've talked before on this podcast about Breeze Eastern a while ago, which was a helicopter rescue hoist business. And that's just an industry that people don't even know exists, right? So those sorts of things are more overlooked.
Got it. Cool. I think that's a pretty good... and for us, if it doesn't... Because, I guess, the way our firm is structured, if it's not overlooked, we don't even take a look at it. And so if you want to sort of follow that, obviously, but if not, these next four are probably the most important for you.
Yeah, and I should say on the overlooked, basically for us, anything we look at compared to most people is overlooked.
Yeah.
Right? Because I'm saying that Residio, which is a spinoff, is a maybe overlooked. But to most people, any spinoff is sort of automatically, well, that's a more overlooked stock.
Yeah, absolutely. Okay, next one, do I understand the business?
Right.
So when you think about that, how does the company earn cash flow? How do they make money? The types of customers that they have. What else do you like to think about it?
Customer behavior. Why does the customer make the decisions that they make? That's the most important part of it of all. So it would be like in the case of Residio, which is Honeywell home stuff, there's two different customers basically. Well, there's three different customers. There's two parts of the business. One is a distribution business, and one is a products business. In the products business, they make some things that are put in your home, and some that are put in your home by installers for like basic things like thermostats and stuff.
Yeah.
But then they're under the Honeywell name. But then there's other ones that are put in by companies like ADT and those things under the name. So it would be under the ADT name. So the question there, the biggest question about do I understand the business is like, do I understand why ADT would choose a Residio? Do I understand why a contractor would choose Residio and not choose someone else? And then in the distribution business, like why would you sell through there versus other things? How big are they compared to other competitors? Things like that. And the economics of it is like basically sort of a DuPont analysis kind of thing, which is asset turns and margins and things of that nature. It's like assessing the moat.
I was just going to say, so do you think it's like thinking about like the moat and if it has a moat? Yeah.
That's what most people talk about. Yeah. To me, the most important thing is needing to understand why the customer, suppliers, people who influence the returns in the business make the decisions on what factors do they consider it.
Do you want to just go, I think it'd be good to name off some forms of moat, like first things that come to mind for me, like high switching costs, patents, contracts, network effects, shelf space, brand, brands, economies of scale, etc.
Right. Yeah. And things that are closer to the customer, to the end consumer, are usually going to score higher in terms of me being able to understand them. Yeah. And things that are shorter term and therefore less cyclical are usually going to be easier for me to understand. Mm-hmm. So it's going to be harder for me to understand, a company that is like a good example of something that would be really hard for me to understand is a company, let's say, that sells equipment to be used in mines. right? So that'd be something that's really hard because it can be put off for many years. I may not know where we are in the cycle, things like that.
Yeah.
I think with Green Brick Partners, we sort of said, I may understand the area that they're in really well and things like that, but as an industry, home builders are a little hard to understand.
Sure.
They're very cyclical, yeah.
Cool. I think that's a good one. So if you don't understand the business, again, you probably should just pass on it.
Yeah, in the case of Residio, I gave it a yes.
Yes.
To understand the business.
Cool. Is it safe?
Yeah. So is it safe? So we should say, is it safe really means, is the stock safe? So we should differentiate between the stock, the common stock, and the business as a whole. So the common stock, you're behind all the bondholders and other people who would be owed money by the company. So a big thing is, what's the credit risk here? Mm-hmm. Because obviously the stock is more dangerous than any bonds. So one thing that I like to do, obviously, is just look for, are there credit ratings?
Yes.
So has Moody's or S&P or Fitch rated any?
You can just do that by a simple Google search as well.
Mm-hmm. And they usually will give explanations of why they rate it the way they do. Mm-hmm. I think in a previous podcast we talked about BWX Technologies, which I said is safe, but that their debt is not rated particularly high. And some of the reasons why is that they have a fair amount of debt, but also issues like the credit ratings firms do things like how diversified they are. Well, they have they get most of their money from one customer, the U.S. government, and from a very small number of product lines with them. So that would that would hurt them there, maybe more than I would say that they were risky, because I'd say that customer is like a safer customer than most. Mm-hmm. So the case of Residio is interesting because they have these sort of legacy liabilities that we didn't talk that much about. So when they spun off from Honeywell, they have environmental liabilities. Honeywell has environmental liabilities. Residio does not. And this I've seen written up sometimes where people get wrong. Residio is going to pay for them. So they're going to pay $140 million a year to Honeywell, which is intended to cover these liabilities. But they're capped, and the liabilities remain with Honeywell. So there are no legal liabilities that Residio has, just that they would have to pay this $140 million if Honeywell has to pay that amount or more. Mm-hmm. That's different in terms of the safety, because it means you're never going to have to pay $200 million or $300 million or something. It's also a little different in terms of the safety of insolvency, because if you read about what cases Honeywell wouldn't be paid in certain cases where it would cause Residio to violate certain debt covenants and things like that. So it's a little bit safer than a bond in that Honeywell's not as well protected as a bondholder would be.
Yeah. And I would add also, after thinking through, is the company safe on like the debt side or like the rating side, I would also think like through like the product side, like how durable is everything?
Absolutely.
So like, are the products durable? And then you could always think like, have the company, has it always existed? Have there been challenges in the past? And what was that based on? Basically think about like, is it going to continue in the future, or like, is it a fad?
Absolutely, yeah. Is it a fad is a really great question to ask. And that's those sorts of things that we're talking about is why I would consider BWX Technologies to be safer than maybe some credit ratings agencies would say, because I would just say that the business is so safe. The products are so safe in terms of the need for them 30 or 40 years down the road. But that doesn't mean that the company is necessarily safe, so you always have to be careful about that. A company that could be a very good business can be loaded up with a lot of debt and become really dangerous that way. Yeah. I own stock in Weight Watchers, which we were confident would survive, but we're not confident that the common stockholders would not be wiped out, because that company had a huge amount of debt relative to its free cash flow. So, and we could talk a little bit about like the amounts that would be safe normally.
Sure.
So as a rule, I would say there are some metrics that you can use. One is the F score, which is not going to really help with predicting bankruptcy risk or something, but it's just a general quality. It's a checklist, 0 to 9, which will give you an idea of whether the company is safer. It's meant to be used with a low price to book type screen. And so companies with high F scores and low price to book would generally be good investments compared to companies with low price to book and low F score.
Yeah.
But the one that people usually use is the Altman Z score, which does predict bankruptcy in the near term. The other,
you could also look at like debt to EBITDA.
Exactly. Yeah. Which, as a rule, I'd say 3 times.
Yeah, I was gonna say actually
you want
4,
to,
but yeah.
Okay, yeah.
Same thing.
I was gonna.
Our minds think a little bit alike. It's all good.
Yeah. So 3 times. I'd say 3 times debt to EBITDA. If you exceed that amount, as a general rule, it'll be different depending on, obviously utilities and railroads and things are different. But if you're exceeding 3 times debt to EBITDA, you might start to have problems with being able to borrow on sort of normal terms from banks and things.
And it's good to also check, like what the industry norm is.
Right,
Like, take like the closest 5 peers and see what their debt to EBITDAs are and understand if it's more or less or why.
Yeah, absolutely. And in general, the things that assure you of the most safety are total absence of liabilities, so very low liabilities relative to the size of the company, constantly positive and large free cash flows.
Yeah.
But like positive free cash flow every year, things like that. And then also very, very high customer retention rates and stable pricing. Mm-hmm. So the things so you reverse those, and that's the danger, which is, does the price of your product vary a lot? Then you're less safe. Do you not retain customers? Then you're less safe. And then also issues of just in general, if you have big changes in cash flow, of how much of your earnings you actually turn to cash.
Yeah. We always talk about, and you could look for this if they talk about like the customer retention rate. That's probably one of the top variables I look for, I'd say.
Yeah. So like,
and then the predictability of that as well.
Right.
And you could see compared this year to past years.
Yeah. So like of stocks that we own or have owned, I would say computer services is probably an example of a very safe company because it generally has no debt. It has like very high customer retention because banks don't generally change their core processor, and it has positive cash flow every year for 20 some years. You can look back in the history. So any sort of software company and things like that.
Yeah.
For people listening to this, probably the greatest example is like a company that's similar to like Microsoft or something is usually a company that's very safe, whereas a company that's like a big steel company or something would be the kind of thing that would be potentially less safe than it might appear on the earnings basis. Yeah.
Cool.
So that company gets a maybe. Residio gets a maybe, with it very much verging on no, not safe. So it was between those, no and maybe, and I said maybe.
Cool. All right. Next one, is it good? So the way we think about this, you could think through like the returns on capital, return on incremental capital, margins, all sort of things like that. But I always think about in probably terms of returns on capital, or some form of it, whether that's ROIC, ROE, whatever. Mm-hmm.
So the one that Joel Greenblatt used, the magic formula, is very popular, and I use a measure that's similar to that, which is basically earnings before interest and taxes divided by net tangible assets. In terms of long-term predictability of a business, the better one is probably gross profit divided by total tangible assets. That tends to be most stable long term in terms of predicting things. The issue with using EBIT and EBITDA, and I wrote something about this on the website a long time ago, is that it has volume issues, so that if certain companies have very, very high fixed costs, and so a small decline in revenue could cause them to not have good results then. Generally, asset-light companies are good, and you want a company that grows. Because we've talked about that before. I get a lot of emails from people talking about companies that have high returns on capital.
Yeah.
But they have no growth at all, and they might be investing that capital now in things that have lower returns. So a good example here is one part of Residio's business that I talked about is very high return. It has very, very high gross profit margin, very, very high gross profit margins. And then it also has decent asset turns, meaning that sales and assets are about equal. Mm-hmm. So it's about 1. So in that case, if you have, let's say, a 60 or 50% gross profit margin, and then sales and assets are about equal, then obviously you're getting 50 or 60% gross return on assets, which is generally a very good sign. The reason why I mentioned gross the gross profit divided by assets, which is it takes away the scale issue, because generally even a business that will be good when it's really, really big will still look good on a gross profitability basis early on in its lifespan, whereas some companies that don't have particularly good returns early on, people will claim will when they have scale.
Yeah.
So a lot of tech companies and things, you'll see this where people will say when they get big, their returns will be good. So to check that, make sure you look at is the gross profitability already really high? Because even before they start turning net profits, they should have really good gross profitability.
Sure. And then I would also add some things that people can do that's outside of the 10K.
Okay.
When they think through like the quality of the business, is if you can get anything like ranked in the industry, do they have any some sort of like awards? They could look on Glassdoor to read about like the company culture.
Sure.
Pretty much read Phil Fisher's 15-point checklist. You could just Google it and you'll find it. And it's also in his book, Common Stocks, Uncommon Profits.
Yes.
And that's a pretty good, I think, measure of quality as well.
That's a very good measure, yeah. Using the general Phil Fisher approach for the culture, for the management, all that stuff is a good thing to look at for is the company good.
Cool.
Yeah.
And then what did you give them?
I gave them a maybe, but it's a maybe verging on yes. The reason why I said maybe is there's no evidence that the parts of this business which ended up being Resideo now, so the pieces that were there in owned by Honeywell and by a company Honeywell merged with, have actually increased their size at all in about 25 years. So going back to the later 90s to today, the business overall seems to be the same size or shrunk a little in real terms. So it didn't keep up with inflation. And we talked about that once before with Hamilton Beach Brands.
Yes.
We're going back 20 or 30 years. We said, I'm not sure that they've kept pace with inflation. And there's explanations for why that might be. Like you have NAFTA during that period and stuff like that, and Honeywell probably moved a lot of manufacturing into Mexico. So it's not terrible, but it is a sign that if a company, so the company on all the qualitative basis definitely has a high return on capital. But if you can't grow at all in real terms, then it's hard to tell if you are truly a good business. For one thing, it means that any capital they have can't really go back in the business to grow it. And for another, you need to keep pace with inflation, really. So I would say every measure says they're a good business, but I just don't have evidence that they've grown at all in real terms in the last quarter of a century. So I say maybe, but I think most people would say, yes, it's a good business. Certainly using like the Greenblatt approach, it's a good business. Yeah, high return on capital.
Cool. So far we have, is the stock overlooked? Do I understand the business? Is it safe? Is it good? And then the last one we have is it cheap?
Yes. And in this case, there's lots of ways that you can look at that, and it depends on the industry. I've gotten a bunch of emails from people saying, actually, it's interesting. I get a bunch of emails from people saying the same sort of thing about different metrics, which are like, I got one recently. Someone said, why are investors obsessed with price to free cash flow? Shouldn't they look at like earnings or something like that, right? Because you're reinvesting that cash flow to grow the business, and and then someone else will say, why are they obsessed with PE? Shouldn't they be that they're looking at these other things?
Do you think that the price to free cash flow comes because Buffett's quote, like the amount of cash you could take out of a business? Yeah,
I think that's part of it. I also think that it was once a very important metric.
Yeah.
As was price to book when Graham talked about it.
Sure.
Was a more important metric years ago. So in the U.S., we've now had cash flow statements for public companies for, let's see, about 30 years, maybe 32 years now. I don't remember the exact year they kicked in. But it would have been late 80s, and certainly every company is reporting it by the 90s. So you have a long period now where you have cash flow statements that people are used to seeing. For companies outside the U.S., it's been shorter. Before that, there wasn't cash flow reporting to investors, so that's a big difference. The quality of the earnings. It's really, that's it. It's the quality of the earnings.
Sure.
So I guess what I would say is, in terms of like, is it cheap? The thing that I've said in reply to those emails is the best metric for earnings for price to something is the thing that matters the most in predicting the future.
And that's the thing. I feel like a lot of people, they just kind of slap a PE multiple on it and call it a day.
Yeah. So it's what matters the most is one of them. So that's objective measure.
Yeah.
But then the problem is that there's two other things that matter, which is what management is manipulating the least. and what other investors are caring about the least. The problem is, say, price to free cash flow. Price to free cash flow is an amazing way to buy stocks if no other investors ever look at it.
Yeah.
Then it would be great. If management isn't trying to run the business at all for cash flow, what they're reporting to you, then it's great. The reason why earnings are often overrated is because, like, go back to the 1990s. Management is obsessed with what they report in earnings, and other investors are obsessed with it.
Yeah.
So there's no advantage that way. You want to find something that works well in predicting the future, but that you are paying attention to more than other investors. It has to be something you know that they don't know, or that you're acting on that they're not acting on.
Well, it's kind of like with Frost, when you valued it based upon the deposits, right?
Yes.
I never really see people value banks with that metric.
Right. But if you look at what happened with banks, what happened was exactly that, which is if you had valued on the deposits, you would be valuing them similarly today as a few years ago when rates were zero. But what happened in the market is a lot of people revalued banks higher when interest rates went up. But it wasn't really a surprise that interest rates would eventually go up. That's something that you could predict. So same thing with oil or anything else. If you're investing in an industry when it's really, in that case, the price of money sort of was low.
Yeah, sure.
In this case, so like if you're looking at, let's say, oil, if the price of oil is low, then you don't want to invest on the basis of earnings in oil companies at that moment.
Yeah.
You want to invest on the basis of reserves and things that in the future will be worth a lot more. So I use lots of different measures. Earnings less than most people do. I don't look at the PE that much. And
it's more, I mean, they're able to manipulate it more too. Right.
Sure.
So you wrote an article a long time ago. I don't know if it was for Focus Compounding or Guru Focus, but you were talking about learning to move up the income statement.
Yeah, that was one of the first things I wrote for Focus Compounding.
Okay. So instead of thinking about it on the terms of free cash flow or net income or even EBIT, you were using it as gross profit, right? Because it's hard to manipulate gross profit.
Yes. So it's that that it can be harder to manipulate certain things is true. One. And there's some numbers that are easier to manipulate and some that are harder to manipulate. And then also what investors are looking at. One of the great things about looking at something like gross profit is no one else is looking at gross profit, right? We had a write-up of a company that was a box. It was a company that was losing money. And I thought it was a really good write-up because it looked at the likely lifetime value of the customer. And saying, okay, so they have this many customers. What would these customers eventually be worth? How much does it have to grow to drive this kind of value? Things like that. Because there's a lot of sales and marketing that goes into initially getting the customer. And then there's a lot of cash flow that comes later. So what you always want to do for is it cheap is look at the thing that drives the economic value long term. So like we talked about Maui land and pineapple. Maui land and pineapple, you want to look at how many acres of land that has all the permissions it needs to be built on and stuff do they own? Okay, it's like 800 or 900. And then you try to talk to some people and say, okay, how much is that those acres worth in West Maui? And if they say, okay, it's worth $500,000 each, and they own 800 acres, then that's worth $400 million or whatever, right?
Yeah.
So that's how you do it. There's no PE doesn't help you there.
No.
Price to book doesn't help you because the land is on the books at prices from about 100 years ago.
So it's held at like nothing, like $5 million or something.
Yeah.
Not even. Yeah.
Yeah. And we talked about a timberland company that we own where some of the land was given, they got some of the land even earlier than that. So in that case, you might look at it, you might try to figure out what timberland per acre is generally worth in that state or in that region or whatever.
Do you think people make it almost too they're just calculating too much instead of just thinking about it in like a holistic type of way? I mean, how hard is that to say, okay, they have 800 or 900 acres. Right. Let's find out how much each acre is worth.
Yes.
And then kind of using that as your starting point, I guess you could say.
Yeah, I think that's true. And
why is that? Is that because, I mean, valuation for a lot of people can be very tough. Is it because like the finance textbooks, you think, or what?
I think so. I also think, I mean, I just talked to some people recently about this issue where I think people often feel like they should be doing some work, and they like with the situations where the people are told there's a right way and a wrong way to do this. Yeah. And doing the work, doing all that calculation, feels like you're doing a lot of the important things, but it's like working harder, not working smarter.
Yeah, sure.
So the like Warren Buffett approach is, okay, what would a private owner pay for this thing? Like he talks about with the Washington Post. and it's true, there are situations where you could say, okay, someone would pay more for this. I've talked a little bit before about a long time ago. I did not buy a stock called DreamWorks Animation. And a lot of people find it odd that I said that was probably the mistake that, like, my biggest mistake in the sense that's most unforgivable. Because the truth is, the reason I didn't buy it, I feel, is just that it didn't quite look incredibly cheap on PE or EV to EBITDA or price to book.
Yeah.
It was pretty close on price to book. It was not overpriced on PE or EV to EBITDA. It wasn't especially high priced, and it was pretty low on price to book. So it was pretty low, but it didn't trip any of those levels as being a clear value stock, right? So it might be a little undervalued, those things would say. But I knew from looking at what they had in their library, and I knew that if I knew that there were, let's say you could pick 8 studios or something and bring them together and have them bid for this company, that the bids that you would get were higher than what the market price was at that moment.
Sure.
Right? And it ended up being sold for a little more.
And that's a private value way of thinking about it.
Right. Yeah. And I knew that Universal and Fox and Sony would bid more, and Disney, if it would be allowed and stuff, would bid more than the market was pricing that stock at. And that's what you want to do. So, like, is it cheap? Is this company selling in the market for less than another company in the industry would buy it for, or a private investor would pay for all of it? Like, take Timberland. Well, some people invest in Timberland.
Yeah.
Would they like to own all this Timberland is to be part of their portfolio at less than the market value is at? Well, if so, then then it's cheap. Yeah. And so that was the mistake with DreamWorks. And it's just a simple thing of asking, okay, well, is it cheap versus what other people would pay for it?
Yeah.
And that's usually the best way of doing it. And that's the approach that I would use. Now, obviously for giant companies and things, people will say, well, they're not really going to be merged with someone else.
Yeah, sure.
So how do you value it? But you can do it the same sort of way. I mean, even if you have to value Berkshire Hathaway, you can say, okay, well, what if you sort of broke up the pieces and said, how much would someone pay for, how much would Progressive pay to merge with Geico? How much would, and go down the list.
No, I think that's great. So is the stock overlooked? Do you understand the business? Is it safe? Is it good? And is it cheap?
Yeah.
Now, what do you think is the most important one? Do you understand the business?
Do you understand the business is the number one. However, the two most important are, is it overlooked and do you understand the business? Mm-hmm. But I should say this checklist is for the early stages. So sometimes in the later stages and stuff, things we didn't even talk about here, like growth and stuff, can matter because you can learn with certainty that something's going to grow, and then that's great. But in the early stages, you can't know that when you're first looking at a business. The two that are most helpful are do you understand it and is it overlooked? And sometimes all you know right away is, might it be overlooked? And do you feel like it's something that you could understand? Mm-hmm. So like we talked about like spinoffs that are coming up and stuff. So we mentioned on a previous podcast Madison Square Garden.
Yeah.
So it is a spinoff. You could probably understand sports related things, but everyone is looking at it. Mm-hmm. So it's not overlooked. So you'd say, okay, I don't know if that's the one I want to zero in on right away. But you could say, you could look at insurance auto auctions or something. And
that's being spun off from KAR.
Yeah. And let's say that you, like I did, wrote a thing on Copart and stuff, which is a competitor. Well, then I would say, oh, well, that is something that I feel like I know, I understand the business, so check on that. And then is it overlooked? Well, the competitor and this company aren't very cheap looking right away. But still, when you're talking about wrecked cars and things for being auctioned off and things like that, that's not the same thing as talking about the New York Knicks, right, in terms of the attention it's going to attract. So that tends a little bit more to be like, oh, that might be something I put close to the top of my list.
Sure,
it's a little more off the beaten path, and yet it's something that I feel like I could understand.
Mm-hmm. I would agree. And that's why we're going to look at it, right? We have looked at
IA.
We looked at IA a long time ago.
Yeah, we'll look at
over a year,
bunch
right?
of those different ones. Yeah, there's not a huge list of spinoffs that we're interested in for the next year, so I think we can cover most of them.
Mm-hmm. Cool. I think that's good. So for people that are interested, I'm going to put that in the show notes, and maybe I'll add some notes on it with it as well on sort of how we think about it. But so definitely check the show notes. Do you have anything else that you want to add to those 5 topics?
No, depending on when this comes out, you may, if you are a free member, you'd be able to read a memo about this topic, about how I rate them specifically.
Cool.
And if you are a premium member, then you actually see these ratings because they're going to be part of the watch list.
Yep.
Yeah.
Cool. Alrighty. Well, we want to thank everybody for tuning in with us here today. If you do join, like Geoff just talked about, as a premium member, you do get a weekly watch list from him as well, where he sort of outlines all these stocks that he's currently interested in, ones that he plans on researching in the future. And then if you do become a free member, you get a weekly memo from Geoff. But if you're a premium member, you also get that as well.
Yeah.
But that's sort of the difference. So if you are interested in that, go to focuscompounding.com and sign up there. Also, if you want to follow me on Twitter, @FocusedCompound is my handle. Let's chat, DM me. Let's talk about stocks. Thank you so much, everybody, for tuning in. We'll see you next week. Take care.
Hey, this is Geoff Gannon, and that was the Focus Compounding Podcast, the podcast where Andrew and I talk general investing concepts. If you want to know more about specific stocks I like, go to focuscompounding.com, where you can read stock ideas written up by me and other members. Membership costs $60 a month, but if you use the promo code podcast, it'll be $50 a month for you. Andrew and I also manage accounts for investors. To learn more about our managed accounts, email Andrew at info@focuscompounding.com or text or call Andrew at 469-207-5844. That's 469-207-5844. Thanks for listening.